So today's program outline, we'll have a welcome and introductory of the events, which I've already done. We're supposed to have a quick video on the benefits of joining SP and who we are as SP, but the internet won't allow that to happen, so we'll skip that now. We'll go on to house rules and we'll have an SP safe start, then an icebreaker session by Kelvin, then an opening address by our YP chair, then an an introduction of the speaker, the presentation of the topic, and then we'll go into our Q&A. And then there'll be a feedback survey in the chat box for us to fill in. And then we'll announce upcoming events and we'll take a vote of thanks from Mrs. Donko, Miss Donko. An important notice for all, let's kindly mute our mics. Let's use the raise hand button icon. If you have any questions, you'll be called to speak at the end of the speaker's presentation. All questions and contributions can be typed in the chat box. I'll read them out. I'll pick a few and read them out for the speaker to answer at the end of his presentation. SPE Safe Stats. So today's Safe Stats is on slip, trips, and falls. We're reminded to be proactive, keep walkways clear, clean up spills immediately, report hazards right away, and wear proper footwears. Kelvin, if you can take our
Yeah, hello. I hope you can hear me. Hello, can you hear me?
Yes, we can hear you, Calvin.
breaker moment.
Okay, all right, okay, sure. So we'll have a short icebreaker session here. Today's icebreaker will be a poll again, like the last time. I'll share my screen so that we can see the results of the poll. We'll be just sharing our ideas on the topic we're discussing today. And so I'll put the join in link on the page, and so you can click this link to join the poll, and then we can have the session. So are we able to join? If you're also on your phone, I'm sure you can scan the QR code. Okay, so I see responses. So I guess we're able to join. So the question is, in your opinion, which factor most affects the bankability of energy projects in Africa today? So far, only one response for high cost of capital. We have weak tariff structures, policy uncertainty, uncertain demand. So far, only one person has joined. Is there a challenge with following the link? Sorry. Okay. Now we're getting a few responses. Um, Out of the three, two have chosen high cost of capital. One person says weak tariff structures. Uh, and if a few more responses, and then we'll go to the next question. So there's only three responses. I see we're up to 20 in the meeting. So uh, we try to reshare the link in the chat so that we can all. So for those just joining, we are having an icebreaker session where sharing our ideas on today's topic. And so there's a link in the chat box you can follow to participate in this. We'll give a few seconds for a few more people. So we have, okay, one person choosing policy uncertainty. Okay, all right, 8 responses. Okay, so I guess most of us are saying high cost of capital. It's the factor which most affects the bankability of energy projects in Africa. All right, so let's move to the next question. Yeah. So, in your opinion, which funding source is most critical for scaling energy projects in Africa? So, we have private commercial investors. Okay, so one response for blended finance structures. The other options are private commercial investors, development finance institutions, and government-backed funding. Which is most critical? We have 2 responses so far, and the 2 responses are choosing that by reducing risk of mixing concessional and private funds. Only 2 responses. Can we get a few more? Okay, now we have government-backed funding and then development finance institutions. Okay, 5 responses. Let's get to the same. Let's have the same 8 people who gave their responses for the first question. So we have 6, 2 more responses, and then we'll move to the last question. So most of us are still going with blended finance structures, followed by the development of development finance institutions. Okay. All right. We have up to 8 responses. So we can move to the final question so that we don't waste much time here. So the final question is from an investor's perspective, what's the biggest risk to energy investment in Africa? What's the biggest risk energy investments in Africa? Okay, so we have political and regulatory risk. 2 people choosing that. The other options are project execution, off-taker credit worthiness, and then currency macroeconomic risk. Okay, so most right now we have 100% of the people participating choosing political and regulatory risk. Okay, 6. A few more seconds, and then we'll end this session. So we have 6. Can we get 2 more responses? Okay. Right, so it looks like a unanimous agreement that the biggest risk to investing in energy in Africa is the political and regulatory space. All right, so now that we have an idea of the topic and we all have come with our own understandings and our comments, I will now hand over to um, how they need to continue, and then we'll see what the lecture has for us. Thank you.
Thank you, Kelvin. I hope you can all hear me. My apologies once again. At the beginning of this session, I had a little bit of challenge with my internet, some connectivity issues over here. But now we are good to go.
Yes,
So yes, so today's topic is unlocking energy investment in Africa, aligning economics, finance, risk for a bankable energy future. I hope you can all see my screen.
yes.
Okay. So the speaker for today's session is Mr. Kofi Kodia Sapon. I'll go into his profile a bit later, but for now we'll introduce our YP chair to give us an opening remarks. Mr. Yao Frimpong Kodia Sapon.
Thank you. Good afternoon, everyone. Let me begin with one simple truth, which is Africa does not struggle with its energy ambition. However, Africa struggles with energy bankability. Across the continent, we have various projects, we have policy frameworks, we have demand, we have natural resources, but capital, which moves only when economics, finance, and risk are properly aligned.
You why? OBC answer my message.
And And that alignment is where many of our projects falter. A technically sound project can fail if pricing is distorted. A socially necessary project can stall if risk allocation is weak. A well-structured project can collapse under currency volatility or policy uncertainty. Capital does not reward intention by reward structure. So today's conversation is not going to be theoretical. My hope is that it's going to be as practical as possible. We will be interrogating what truly drives project bankability, how funding structures in Africa compare with global best practice, and where do the risks typically sit, and where should we also be sitting, and if we want to get our projects through. This is why we're privileged to have Kofi lead this discussion. His career sits at the intersection of capital markets, treasury management, structured finance, and market infrastructure reform. He has advised on significant debt and equity transactions across multiple sectors and jurisdictions and continues to shape financial market standards locally. On a personal note, I will say this briefly. Yes, that's my brother. But today he joins us in his professional capacity, and I look forward to the clarity he'll bring to this particular conversation. Because unlocking energy investment is not about optimism, it's about discipline. And discipline begins with understanding how capital thinks and works. Carl, the floor is yours to continue with the introduction. Thank
you. Thank you very much. As he has already alluded, it's his brother. We are going to get the talk from today. It's exciting to see that it's a family of siblings and brothers in the energy and finance space. We believe that this is going to be exciting because our own YP chair has given us so much knowledge over the years. So we know that his brother is about to impact us with even more. So I'd like to introduce Mr. Kofi Kodia-Sarpong. He is the founder and chief executive officer of Sarpong Capital, an independent advisory and capital market firm he established in 2023. Mr. Kodia-Sarpong has over 15 years of experience across investment banking, corporate finance, treasury management, having previously held senior roles at Deloitte, the Royal Bank. His advisory and transactional experience spans industries such as financial services, transport, manufacturing, construction, healthcare, education, shipping, and real estate across Ghana, Nigeria, South Africa, Australia, and the United Kingdom. Mr. Kodia-Sarpong is a chartered accountant, holds an MSc in Finance and Accounting from the Manchester Business School, as well as a BSc in Accounting from University of Hull. He's actively involved in shaping Ghana's financial markets, serving on the industry and regulatory committees, and contributing to market development initiatives across the securities and foreign exchange space. Allow me to introduce to you Mr. Kofi Kodia-Sarpong. Sir, the floor is yours. You can share your screen and take us through what you have for us today.
All right, thank you very much. And I hope I can be heard audibly across by everyone.
Yes.
Can I be heard?
Yes.
And can you see my screen?
Yes.
Fantastic. Thank you very much again. So today's conversation is really going to, it's a dialogue really. And I hope to learn as much from you as you can learn from me based on your understanding. The poll that was held a few minutes ago was pretty insightful across how people think around how energy projects are financed and what the constraints really look like. Today's conversation, we're going to touch briefly on understanding what infrastructure is, look at the context. We'll talk about the factors that really affect project bankability. We'll look at financing in practice, how engineers can affect the project. Then we'll have concluding remarks, and then we can have a Q&A session. So that's the game plan for today. When we talk about infrastructure, really what we're talking about are those projects that that provide services for various things that we do. So we're talking electric power, which is the generation, transmission, and distribution aspect of electricity. Then we're looking at broad energy, which are the refineries, the oil wellheads, the pipelines, the processing facilities, etc. And in telecommunication, we also have infrastructure as well. The telco masts that you see, the data centers that you see, those are all infrastructure as well. Then when we come to transportation, we've got infrastructure being the roads, the ports, the railways, and the airports that you tend to see. And all of these constitute infrastructure as well. Then when we come into water and sewage, we're looking at the water treatment facilities, the desalination plants, and all of those things. Those also constitute infrastructure. And then when we come into the healthcare space, we're looking at our hospitals, the equipment, the CT scans, the PET scan machines, all of those together provide you with your healthcare delivery infrastructure. But for today, our focus is the energy space. And by energy here, we're talking about the electricity generation, transmission, and distribution space, and also the oil refineries, the oil and gas processing facilities, the pipelines, and all of those associated infrastructure. So that's our focus in terms when I say infrastructure today, that's what I refer to. Additionally, I'd also want to put it in context that when I mention Africa or when I say Ghana, I mean Africa. When I say Africa, I mean Ghana because it's interchangeable. The issues you tend to find are typically the same across board. So don't worry when you see Ghana a lot because that's what I focused on in terms of the presentation. No, so the context today is that Ghana sits at the intersection of three realities where we have proven offshore oil and gas resources, and quite frankly, there's a bit of exploration going on onshore as well, and we know that is there, so we'll find it as well. Then we've got our power and industrial energy deficits as well. But then one of the things we have is also abundant global capital that's looking for places to be put to work and to use. But all of these elements remain poorly connected, and why is that the case? And that's what today's presentation seeks to really explain, and why technically viable projects tend to fail financially, how engineers like yourselves, sponsors, policymakers, what they can do to unlock this investment in capital. Now, the energy reality in Ghana is pretty simple. You've got a prevalence of inefficient monopoly providers that are usually state-owned. We're looking at VRA, we're looking at ACG, we're looking at Gridco, and they're state-owned. But in addition to being state-owned, you'd think that they're efficient. They're pretty inefficient in the way they offer and run their services. And as a result of that, they tend to have a bit of they struggle to attract capital to modernize their infrastructure because a lot of the prices of the tariffs that they use to do what they're doing is being held below cost. And why is that the case? As your poll showed, it's that usually government policy is the reason why. Then additionally, we've got inadequate expertise, but we're finding out that in as much as that is the case, it seems to be transitioning because we're having a lot of experts, Ghanaian experts who are providing these services outside of Ghana. They tend to find their way back home from time to time when the offshore international markets aren't doing great. They tend to like to come home. So that experience comes back home from time to time. But broadly and largely, we tend to have this inadequate expertise for project finance structuring and stuff. So we do see that as well. Then there's also a lack of depth in terms of yield curves for local debt market, capital markets. What do we mean by that? In terms of the ability to finance projects, you find out that the most you can borrow money from the banking sector or from the bond markets locally is typically for about maximum 15 years. Then you all agree with me that infrastructure such as gas processing plants, they tend to have 20, 25, sometimes 30-year lifespans. So the financing has got to match there. Then we've got an absence of incentive mechanisms that encourage infrastructure financing and spending. And here we're talking about a tax regime. And that's, again, a form of government incentive. And we've got to find a balance between taxing certain projects versus attracting that capital to come into the country to invest. So the fiscal authorities have their work cut out for them. Then we have offtake agreements, and here I always bash ECG because they seem to be the easiest child to flog here. It's normally it's concentrated in one buyer that typically is distressed or as inefficient as they come. And yet we still continue to make sure that they are the ones doing the offtake when we need to probably be looking at different ways of designing our offtake frameworks. Then we've got the biggest culprit being the electricity tariffs, which are always sensitive issues. At what point in time do you get a cost-reflective tariff to recover the investment that you've put in place? Do I do a tariff that allows me to recover my investment over a 30 to 50-year period, or I put a tariff in place that recovers my investment over a 100-year period, or a tariff that allows me to get in and within 10 years I've recovered my investment and I'm out of the system? And those are critical questions that we have to ask as a nation, and also our policymakers really need to get their heads around. And the biggest issue from a macro perspective is that the expenditure is usually US denominated, but the revenues are largely coming out in cities, and that becomes a big challenge when you have FX volatility rearing its ugly head into the mix. Then from a governance and management perspective, the public sector as an equity holder is always problematic. When you have a 4-year election cycle, that means that every 4 years there's a policy reset. There are new faces in there making policies and trying to impact on the economy. So that becomes a critical problem for projects that we embark on. Then the way in which we design our concession holders, again, is influenced by politics. And so you tend to have the square pegs and round holes during the initial stages of most projects. So that affects the outcomes significantly. It's very rare to have a project that has all the pegs in the right order. Then we have commercial risk from a debt finance perspective, as you see down the line. And then we have our sovereign and cross-border risks that come into play here. So invariably, all that we're saying here is that these two broad issues, macro and structural barriers and governance and management barriers, tend to be the main reasons that that projects fail to become bankable or struggle to raise the appropriate financing to get them off the ground. However, the truth is that when it comes to bankability, it's more than these two broad issues. It's more than solving these issues. Okay, the real issue is that projects really become bankable when 3 things align. That's the economics, the financing, and the risk management related to the project. And what do we mean by this? Here we're talking about matching the cost with the price and the revenue that is being created, ensuring that the demand is real, dealing with your FX risk, ensuring that cash flow and capital tenors match the profiles that we are setting, and that risk is appropriately priced. And when we say risk is appropriately priced, what do we mean here? I mean, are we paying the right interest rate on the debts that we're taking? Are we looking at the right equity returns that equity investors are getting out of the project? And are we allocating the risk to the right people or the right parties that are required to handle that risk? So it's only when these 3 things really come together that a project can become bankable. So let's start with economics. The economics is the numbers don't work. Nothing else really matters here. I mean, there's no other way I can say it. If you don't know what your gas processing costs are, let's take a typical gas processing project. You don't know what the costs are. You don't know what the pipeline and tariff costs are. You
Sorry,
don't know what your
Mr. Kodiasapon. Sorry, if you could
yes.
amplify your voice a little bit for our listeners.
Okay, all right. Is it clearer now? Hello?
Yes, it
Is
sounds
it clearer
much better.
now?
Yes.
Okay, all right. Thank you. So as I was saying, if you don't know what your gas and production and processing costs look like, or the transport tariffs, or the power plant capex, or the opex looks like, or the pricing the tariffs in terms of the electricity pricing on the output side, or what your demand profile looks like, then you're going to struggle to even determine what the levelized cost of the energy that you're producing looks like, what your net operating cash flow looks like, and how you're even going to cover the debt service ratios. So those things must come together. That ensures the bankability of a project and the success of that project. Okay. Now, if we take an example, for example, in Ghana, a typical transaction is let's look at a gas to power structure where you're putting a series of projects together aimed at generating electricity. Even on the gas side, you realize that your EPC contracts are denominated in dollars. Your gas supply is priced in dollars. Your debt is most likely in dollars. But then the energy or the electricity cash flow coming in, or what you're selling the electricity at, is in cedis. So the effect of this is you're going to have FX exposure, you're going to have a volatile debt servicing profile, you're going to struggle to pay the debt back, and you're going to create immediate lender concerns. Okay, so even a great project can appear risky just because of these four things that are, or these few things that are going on in one project. Now, the risk that you face comes directly out of the economics of the project. Okay, so when the misaligned economics, the risks just start getting created and they multiply. Okay, so when you take a non-cost reflective tariff structure, the resulting risk is off-taker risk, and the person who typically the entity that holds it is a utility, and the result of that is a weak balance sheet. So that utility cannot borrow money to sustain its operations. Okay, can I be heard?
Yes, you can.
Fantastic. When you look at FX mismatches, again, it creates a currency risk, and then the people who bear that risk are usually the sponsors, the lenders, and then also consumers, because you can't really hedge the currency risk properly, and that becomes a big problem for entities in that that are
Sorry, Mr.
affected by
Kodia.
FX.
For
Yeah.
some reason, once you start speaking, we can hear you. After the voice goes in the background, and then.
Okay, just a minute. Let me switch devices to my microphone. Just a minute. Is it clearer now?
Yes, please.
Okay. All right. Let's try this and see if this will be better. Okay. So the next thing is the weak demand, and that creates demand risk for the project. Okay. And usually it's the project that suffers as a whole. And then the problem there is the revenue volatility. When you have revenue volatility, that means you cannot pay down your debt and manage the operations coming out of the project. Okay. Then you've got high upfront capex, and that results in construction risk. And here, typically, it's allocated to the EPC contractors, the sponsors, and also the equity holders or equity investors in the project, which results in a high upfront capital cost, which then translates into weaker balance sheets down the line when the cost of the project is too high. Then you have policy pricing. This creates regulatory risk, and we expect the government to own this particular risk. And the problem here is policy reversals. That 4-year cycle I was talking about, every year they come up with a new policy, and you've got to backtrack on something that affects the project structure at the end of the day. So the bottom line here is that the risk tends to be concentrated usually in the weakest part of the system, and that's just by the design. So we've got to figure out how do we fix this. But the truth of the matter is, can I be heard?
Yes, you can.
Okay, thank you. So the truth of the matter is that no matter how hard you try, you can't fix the bad economics on a project through great financing. Okay, because financing only amplifies the economics that you've identified and you've aligned, right? So financial engineering cannot rescue the project from weak tariffs. No matter how great I am at structuring, if the tariff is weak, it's no amount of structuring can fix it. If there's unclear demand, there's not much the project structure that I've got in place or a financing structure I've put in place can fix that demand. It can only be fixed by making sure that the demand is clear from the onset and making sure that if the demand is not very clear, we don't even embark on the project to begin with. If we can't hedge the FX, well, that one, sometimes some financial engineering can fix it, but largely where there's FX volatility, there's always challenging in the financing. And then any pricing that is politicized, okay, that goes back to the weak tariffs issue as well. So our deal structures we typically design deal structures for projects around the economics of the projects, and we try to solve a lot of problems, but there are a lot of things that our financial and deal structures cannot solve if the economics just don't make sense. Now, in terms of financing, it's always important to find the right source of capital. I mean, from wherever, from the onset of the project. Okay, so we're going to look at the financing pathway for a typical oil and gas or exploration project, and it has a number of distinct financial phases, right? And those financial phases are the exploration phase, which I'm sure all of you are conversant with, the discovery phase, the proven reserve phase, and then the monetization phase. And during each of these phases, the key activities are we're doing the geological work, we're determining where exactly we've got to explore and drill, and all of that is pretty dense activity during the phase one. Phase two, we're looking at our reservoir definitions, flow testing, the initial plan of development, and all of those things. And then we're looking at the phase three, the independent reserve certification, the plan of production, and then commencing production. And then phase four is when we try to monetize the project fully by now getting people to offtake out of the project. And then that's where we get all these sexy project finance structures and SPVs that get created. But the most important thing to keep in mind about the development life cycle of a project is that when you look at all of these phases, the risk profile becomes very clear, and then the type of financing you need is pretty evident at that point in time. So during the phase one, you've got a high risk project, and that's typically sponsored or financed through equity or sometimes convertible debt. Then the stage two and stage three of the project, you tend to have medium risk because at that time you've identified something. You think there's something doable there, and therefore you want to finance that. So it becomes less of a high risk venture at that point and becomes medium risk. And there we can look at equity again. We look at convertible debt again. We can talk mezzanine, which looks like both equity and debt. Then you've got the typical junior debt, and then the subordinated debts that we tend to hear about, and then reserve-based lending. Then when we get to the phase four, which is the lowest, when you're monetizing it, the project is then deemed de-risked or lower risk at that point in time. There you then see the typical bank debt, the typical project finance debt that comes out, and there's and the various structures there. But a key note here about reserve-based lending, which is in the phase one, phase two, and phase three. When you take a project like the Jubilee Field, for example, you've got the Cosmos Energy. Around when they got to where they were doing the reserves in the Jubilee Field had been proven, at that point in time, Cosmos was able to access a multi-billion-dollar borrowing base facility, which allowed them to use the estimated reserves as the base to do some borrowing. So it's basically, we think there's 10 million barrels of oil down there. Sure, we'll give you some 1 billion for each barrel or that comes out in there, or some 1 billion for a million of those barrels that are going to come out. So they were able to tie it. And so at that point in time, you realize that the success of the project, which is at that point, the engineering work that had been done was crucial to unlocking the capital that they needed to really unlock the reserves that were there, because it was going to create something more of a predictable stream of cash flows. So this just goes on to summarize or put the sources of capital that I identified previously, the medium risk, high risk, and lower risk sources of risk together, and put the capital that you can get out there. So you've got the banking market capital that you can find, the public debt market, which is basically the bond market, industrial partners. Sometimes your EPC contractors will provide you with capital to develop the project. Then you've got the investment funds, your hedge funds, your sovereign wealth funds. I wouldn't call SNIT a sovereign wealth fund, it's a pension fund, but you've got something like GIF acting as a sovereign wealth fund for infrastructure. Then you've got the equity capital markets where you can do IPOs of various projects and raise some money. And private equity here, they're similar to the investment funds, but they pool only private equity to do that, to do the projects for energy style transactions. Now, one of the key things you want to know when talking about energy projects is that it's easier to finance. You'd think that power and gas infrastructure should be easy to finance, but it's actually easier to finance upstream oil and gas than it is to finance power and gas infrastructure because they have contrasting cash flow and risk profiles. The key thing about the upstream oil and gas is that all the revenues that are being generated are US denominated export revenues. There's a global market for oil and gas. The pricing is subject to international benchmarks, and then political risk here is limited really to the taxation on what is being sold on the international market, and then the buyers are typically creditworthy international buyers. So it's easier to do an upstream project that is exporting the outputs than it is to do a power and gas processing facility in country. And that's because the revenues you typically see in those projects are denominated in local currencies, by and large, local currencies. Then there's usually a single off-taker or utility that is taking all of that output. They have a weak balance sheet, so lenders don't trust them. There are tariffs which are subject to political interference, and also you get institutions like maybe the PURC setting tariffs on the output from these projects, making them below. I mean, you struggle to recover the cost of the project. Then you've got FX convertibility risk here rearing its head again. Then you've got credit risk that's trapped inside the domestic economy. What do we mean by that? It just means that you have local bias of the outputs, really, and these local bias are subject to the domestic economy, the conditions that exist in the domestic economy, and that transfers itself to you as an infrastructure project as well. And then, as I've said before, the sponsors are local and often have weak balance sheets that to support those transactions. But then the impact here is that banks will price the power projects as a sovereign linked risk and not commodity risk. The upstream is seen as a commodity transaction, and therefore it's subject to commodity pricing risk. Whereas the power infrastructure is seen as an economic or sovereign related entity, and therefore subject to domestic and sovereign risk that affects the financing there. So this is one of the key fundamental financing constraints to projects in Ghana. Now, let's talk about how these projects are really financed in Ghana. Okay, so typically we use project finance to finance projects, energy projects and infrastructure projects in Ghana. And we use the SPV as, I was told that if I don't say SPV in this presentation, some people will not be very happy. So today I've said SPV. I think this is my second time I've mentioned it. And I'll say it a third time and a fourth time as well, so that I get the point across. It's a standalone project company, really, that we use to do a number of things, okay? And those things I'll talk about shortly. But typically, the project finance structure that we do here is usually to isolate various types of risks in a project and then put them together or allocate them to the parties that are better suited to manage those particular risks. Okay, we isolate the cash flows into one pot, we isolate the security over the assets into another pot, the contracts into another pot, and then that makes for how do I put it? It makes for it makes people sleep better at night when you structure the project properly using the project finance mechanism in there. So most project finance, as I said, is done using the SPV. I think this is my fourth or fifth time now saying that. But then it's done to really achieve three things. Now, if you remember our slide from before, which was aligning economics, risk, and financing. Well, when we do project finance and we create an SPV, all we're trying to do is to align the risk and the financing and risk framework together. Okay, so we try to bring everything together in the SPV and compartmentalize the risk and the financing. Now, that brings us to what lenders or what investors also really care about when we're structuring these type of projects. What we care about is cash flow predictability. Does the tariff make sense? The feedstock or the gas pricing, does it make sense? Is there demand certainty? I've mentioned this before. Can the revenues reliably service the debts in the project? Who is carrying what risk? Who's carrying the construction risk? Who's carrying the off-taker risk? Who's carrying the regulatory risk? Can contracts be relied on to work, and can they be enforced? And all of that comes together through the project finance special company or the special purpose vehicle. So what I say is that the SPV, that's where economics, risk, finance, and discipline are enforced through the project company. And through this project company, that's where everything related to the gas pricing, the tariffs, everything, we allocate them cleanly and in a sensible manner. We will have a supply agreement for. So let's take a gas processing plant such as what Ghana Gas has. The feedstock comes from somewhere. There has to be a supply agreement to feed into the plant. There are consultants, those who did the engineering and construction design, they will be there. Those who are actually going to build it, they'll be given a contract to manage the cost of the contract. Then we've got who is operating it, an operating and maintenance agreement. It might be Ghana Gas themselves, or they may have a third party plant manager to manage the facility. There's a reason why, because we want to make sure that we keep operation costs low, and we also ensure that the plant is always operating to spec. That's a very important detail there. It must operate to spec. Then we now come up to, okay, who is buying what Ghana Gas's facility is producing? All right, where's the revenue going? It goes into an escrow account, which is then used to service the debts that the lenders brought into the project. Once the debt is being serviced, the cash flows cascade downwards, and then the project is then able to pay the equity investors their expected return or their return at the end of the day. So together, this is how we make sense of projects from an economics point of view, risk point of view, and also a financing point of view. We use the special purpose vehicle, a project financing mechanism, to fund the development of the project and also the operations of the project. Now, what can engineers do differently here? You're an engineer, you're in SP Ghana today, and you're an engineer, so you're asking, so how does this apply to me? Well, perhaps you, as an engineer, you want to, and you're involved in the design phase of the project. So what we're saying is design the project with the financing in mind, not just the capacity of the project. Make sure that you are phasing the developments to reduce the upfront capex, because the more we spend on the project in terms of capex, the more it's either we have a high tariff to recover it, or if we have a low tariff, it means we spend maybe 50 years or 70 years recouping that investment. That doesn't make it too great for investors' appetite in that regard. So we want to make sure that we're phasing the development properly. We're improving the data quality for whether it's inflows or feedstock into the project or the output of the product. We always want to make sure that the data quality is at a high level for lenders to be able to assess, for investors to be able to assess as well. Then we want to align the engineering timelines with the lenders' processes. When we want to lend money, we need to understand from an engineering perspective what is needed, what is needed by when. Okay. Then you want, as engineers, you always want to engage, or project managers, you always want to engage the financiers during the feed stage when you're doing the front-end engineering design. That is when you really need to bring the investment bankers in, the investors, the equity investors, the debt, the lenders into the conversation, so we can all think in terms of cash flow as well as molecules, and make sure that everything is aligned to make the project work out. So to conclude, what I've done is we've talked about at a high level about infrastructure, what infrastructure is, why projects fail or succeed, how bankability is created, what the financing pathway looks like, why some energy projects are easier to finance than others, how economics, risk, and finance must align to achieve their bankability. But what I really want to close by is going back to our alignment framework, and I'll take you back there, where we're saying that, look, it becomes bankable when economics are realistic, when risk is allocated correctly, and the finance and cash flows align. So let's align economics, let's align the risk, and then the financing will flow. So Africa doesn't really lack any gas. It doesn't lack engineers. Capital is available, but what we tend to lack is the alignment in terms of bringing the economics, finance, and risk together. So the projects will only become bankable when these three things come together. So let's talk again. The economics, costs must match the pricing. The demand must be real. Okay, revenues have to be sufficient to service debt. If the numbers don't work, nothing really matters. Then construction risk, off-taker risk, FX risk, all of those risks need to be allocated properly. Okay. And then once all of those are aligned, the financing then falls in place. So for engineers in the room, it's important to know that your design decisions do tend to shape the economics of every project. The timelines you put together also shape the risk of the project as well. And then your data quality shapes the financing outcomes. So I'll bring you back to our alignment framework. And if you've noticed, the framework has turned around. Again, I said when you align economics and risk, financing then flows through. So that the table has turned. By bringing economics and risk together, the financing for your projects will typically flow. Thank you very much. And that is my presentation for today.
Wonderful, wonderful, wonderful. Thank you, Mr. Kodia Sapon. You heard it from the man himself. Financial engineering cannot rescue a project with weak economics. I think we've heard so much and we've learned so much. At this point, I'll take the questions in the chat box, but I'll begin with myself. I have a few questions for Mr. Kodia Sapon. The first question I have is Forex, FX. Do you think that FX plays the majority role in investment decision? Do you think that most investors are looking at the CD thinking that, okay, if it's getting weaker, we are not investing. If it's getting stronger, we are going to invest. Do you think that does that weigh more than the other risks, or is it the highest among the risks that you've highlighted for us? Secondly, I also want to find out that just as you've said to us here today, is there any reason why the banks are capping the period for their lending at 15 years? Since you've already mentioned that some of these projects, like the gas projects, like 20, 25 years, I think that as long as there's a return beyond the 15 years, these banks should be interested in keeping their capital there. Is there any particular reason they are capping this at 15 years for the Ghanaian projects? Thank you.
All right. Thank you very much for your two questions. So in terms of FX, no, FX is not the main risk. So the risk is the metric that the investors typically look at would be what kind of return and what kind of impact does the project make within the economic space that they are thinking of developing the project. The FX risk only see the FX rate, or the FX exchange rate only quantifies it in dollar terms for them. Yes, when you enter the market at, say, when the rate is around 6, and you develop a project at investors would have advised on in terms of how to mitigate FX risk. Because when you look at the long-term curve for FX, you tend to see FX is always the currency is always depreciating. So you want to have a number of structural hedges in place, either at the in terms of the tariff side, or you want to be able to hedge the currency for in terms of the development of the project. All of those things would have been put together by your financial advisors in the project. So I wouldn't say it's the main one, but it's certainly one of the important ones that they would look at when crafting or conceiving a project. Now, your second question has to do with the tenor of banks. Now, this is one that we tend to fight with the banks over a lot in terms of the ability to finance long-term projects. Most banks will probably do 5, 7 years, and then they tend to refinance for another 5 or another 7 years, giving you that 15-year span of product. But it's all because of policy shocks from a sovereign point of view, changing the policy cycle every 4 years. That doesn't help planning. When new governments come in place and then suddenly a policy has to change just because there's a new administration in place, then that it makes it very difficult for banks to lend into those type of scenarios unless they have guarantees. And you can only have those guarantees depending on the project structure that you've put in place. And then perhaps who the sponsor of the project is. If government is a sponsor of the project, then what you're going to find is that as part of the deal structure, we're saying, well, as a government, please give us guarantee that when there's a change of government, you are not going to be changing X, Y, or Z variable in this project, and we are happy to lend into it, or we are happy to provide equity capital into it. So that'll be how the banks look at it. But certainly, that policy cycle reset is a big issue for banks, and that's why you see them not lending long term. Another reason has to do with the nature of their funding base. Until 2015, the local market itself didn't have an active bond market. So that the absence of such an active bond market meant that the ability to issue debt long term was constrained somewhat. But since that time, the introduction of the bond market means that you can actually come into the market and issue out debt that is 10 years, 15, sometimes 20 years, or even more in terms of the tenor. So there are now avenues for you to raise that kind of debt in the local market. But from the international market, again, that policy cycle that people aren't very sure of, it also affects the international banks or the international investors who are coming here. Hey, if every 4 years there's going to be a policy reset, then if I give you $10 and every 5 years I have to worry about there being a reset, that will also create a currency issue, then why would I want to bring my foreign capital into your economy? So we need for these kind of infrastructure projects and large energy projects, we do need stability from a policy point of view.
Okay, thank you, Mr. Kodia Sapon. There are a few questions in the chat box. One participant is asking, there are many instances project economics make sense, the risk mitigation is high, but the capital remains a challenge. How do we mitigate it?
Okay. So look, when you say capital remains a challenge, are we talking local capital or international capital? Because if those the three things I said are aligned, the risk is aligned, the economics make sense, okay, the financing will flow through, whether it's coming from offshore or local markets. Today, there's a pension fund market in Ghana here, pension investors. Your pensions that you are paying today, I can tell you comfortably that they are in excess of 100 billion Ghana cedis today. So any project that you needed to finance long term, if you are talking to the right investment banks, you'll be able to attract the long term capital that's needed for these projects. Now, if you're looking at tapping the international market, again, the risks and then the economics need to make sense to them. and we need to mitigate the risk appropriately for the type of capital that's flowing in, and then that finance flows in easily. So I struggle to see when projects aren't, say they can't find capital, it's a difficult thing. I'm wondering who is advising these projects.
So that means your project advisor is equally important as
Very,
the
very important, actually.
that's in the capital itself. Okay. So another participant is asking, talking about stability in terms of risks attributed to government policy and FX. Can we talk about
Hello, I seem to have lost you.
The question was on the feasibility of hedging in the Ghanaian market with respect to risk attributed to government policies and ethics.
Okay. Yeah. So what are we asking, whether we can hedge those risks in the Ghanaian markets?
Yes, please.
Sorry?
Yes, please.
Okay. All right. Yes. Yes, you can hedge FX risk in the Ghanaian market. In the past, probably like maybe 15, 20 years ago, it would have been challenging to hedge foreign exchange risk or interest rate risk in the local market, but these days it can be done relatively easily. So FX and interest rate risk is not something I worry about in projects today. Again, who are you talking to? Who are your advisors? I always come back to these questions. You've got to hire advisors who are in the know in terms of what to do or where to go for risk management solutions across FX and interest rate. Now, when it comes to political risk, again, who you are talking to is important. There are entities today, sometimes the export credit agencies and also the likes of IFC and the World Bank. They'll be able to sell you political risk insurance to hedge against the risk of policies changing through the life of a project. So all those risk can be hedged in today's environment in Ghana.
Okay, thank you. If Akoto, you have the floor, your hand is up, you can ask your question.
All right, thank you, Carl. And thank you, Mr. Kofi Kudiasapon, for your presentation. I personally am not so conversant with some of the economics terms like SPV, which you used. And so I would like you to explain it in simple terms so that I can appreciate it. Thank you.
All right. Thank you very much for your question. And I'll do just that for you right now. So in terms of an SPV, or when we say SPV, all we're saying is special purpose vehicle. SPV means special purpose vehicle. It just means a company that is created for the sole purpose of a particular project. So permit me if I use maybe Ghana Gas, or I use ECG. Okay, today. So ECG today is an electricity distributor. Okay, ECG finds that, okay, I'm at the mercy of the independent power producer. So I myself, I want to create my own power plant for my use, my own purposes, as opposed to relying on just the private independent power producers. So what do? I have the option of of developing the project on my balance sheet as ECG, or I have the option of putting the project into a special purpose vehicle, so that when lenders and investors are looking at the project, they can look at it in isolation from me, ECG, my risk as a corporate entity or as a utility. And so that's where the concept of an SPV comes from. And all we're doing here is that we're just isolating various risks and compartmentalizing them in a project company or a specific entity to hold all of those risks. Okay. And that's the purpose of an SPV. Now, you may say, okay, ECG, but ECG themselves, why would they do this? Because their balance sheet is weak. Okay. They struggle to collect. Why would we want to isolate the project from ECG? We say, okay, yeah, we want to put the project out of ECG's balance sheet because one, even the ECG themselves, they struggle to collect 100% of the revenue that they generate. So if they struggle to collect 100%, why would we let the project be directly attached to them on their balance sheet? It means they can't pay for it. However, if we split it off separately, what we have done here in that special purpose vehicle is that now that vehicle is providing a service to ECG. They must pay for it. Where ECG struggles to pay, the IPP can or the company can now say that, okay, this power I'm producing, I'll sell some to Anglo Gold Ashanti. I'll sell some to Newmont. I'll sell some to Goldfields. I'll sell some to B5 Plus. And then that's how the project then is able to recoup the investment and pay for itself as well. So that's why we would create the SPV. Secondly, the lenders here can decide that, okay, ECG is no longer able to pay for this project. We are not going to sell anything to them. We'll take control of the project and we're going to sell it to somebody else. Then all of a sudden we hear that, oh, Car Powership or Senate have decided that, we think we want to buy this power plant and add to our existing portfolio of power assets. And we say, okay, great, we'll give it to you, we'll sell it to you so that we can recoup the investment that we've made into it and then walk away from it. And then you guys can manage that project now. And that's why we typically create the SPV or the special purpose vehicle to manage risks. I hope it's clearer now.
Yes, Mr. Kofi Sapon. It's okay. I get it now perfectly well.
Fantastic.
Thank you.
Mr. Kodiasapon, if you don't mind, the last question from Joe Abuaje. Wouldn't take any more of your time. Thank you.
Mr. Sapo, thank you very much for the presentation. My question is in regards to the source of capital. In your presentation, you clearly stated that the banking system probably mostly looks like at the economics of the projects, also at the policy change in our macroeconomic sector. But I also want to ask questions on the private equity source. Do they also have some metrics they normally look at aside the economics of the project? Is there some rules they also play by?
Well, by and large, private equity investors are also financial investors. And so when they are putting money into a project, sometimes there are like two types of private equity investors. There are those who want to be directly involved in the management of the company that they're investing into, or they just want to put their money in and just watch their money grow or work. So those are the two types of private equity investors. But in terms of the metrics that they're looking at, it's no different from what a bank or a lender would be looking at. They all look at NPV, they all look at IRR. NPV is the net present value. IRR is the internal rate of return. They'll all be looking at the same metrics to make an investment decision. So in terms of really, look, banks will also look at management quality, and also a private equity investor also want to put money into a company or a project that has competent management running or conceptualizing various projects. So really, they're all looking at the same thing. If you ask me, it's not too different.
Thank you, James. Quickly, please.
Okay, just a quick one. In your presentation, you made mention that Ghana has proven oil reserves, right? But
Yes.
over a period of about five years and over now, we are not seeing any new investment into the upstream space, right? This morning when I was listening to the radio, in the mining sector, the government introduced the sliding scale, right, from 5 to 12% of royalties. And then the Ghana Chamber of Mines also brought in a counter proposal saying that is on the high side, but they want to do a 5% to a 8%, right? Do you think some of these factors are affecting our attraction of investment into the upstream space, right? And then quickly, for the second one, do you think engineers make or engineers make good investment bankers? And will you, in your own view, encourage engineers to possibly move into the investment banking space? Thank you.
All right. I'll answer your second question first, and I'll come to the first one. The second one is yes, everybody makes a great investment banker, to be fair. And so I've seen in my lifetime great historians who have become investment M&A investment bankers, infrastructure investment bankers, debt capital markets investment bankers. So it really doesn't matter too much. It's just what your interest in the area looks like. What's your interest in finance? What's your interest in numbers? What's your interest in doing deals, getting deals done? And I tend to joke about what we do as investment bankers. Really, it's not rocket science. All we are doing is addition and subtraction. And the most complicated thing we probably do is division. So if you can do all of those, you can make it out as an investment banker relatively easily. So it's not too difficult. If you want to come over into the investment banking space, certainly your engineering background will give you a stronger grasp of numbers and how they all fit together better than somebody who doesn't really have the financial acumen. But that doesn't mean that you become a better deal maker than them. Some of them just might be great at conceptualizing stuff and creating deals and making it happen. You might be a great number cruncher, and therefore your skill set is in number crunching and making sure that the numbers make sense or there are opportunities in the numbers. So yes, every background is welcome in investment banking. Now to your first question, whether Ghana is an attractive investment because of the fiscal policies. Certainly, fiscal policies do play a role in attracting investors. The level of tax that you charge them when they come into your economy flows into the financial models that they make use of in determining what type of whether they want to invest or not. So certainly it's important. For moving from 3% to 5%, some may scream, but you look at the big picture. If you're making 10 billion and your host country is asking you to pay 5 or 10% in royalties, you clearly you haven't lost much, really speaking. Over a long-term period, you've not lost anything at all. So sometimes investors make noise over nothing, but then in the short term, yeah, it kind of it makes it look unattractive. But over the long term, they tend to come in and play the game the way it needs to be played. So I don't think that it will make Ghana a less attractive destination when royalties flow into government coffers and government is able to provide enhanced government services, enhanced infrastructure, roads and healthcare and everything. It even makes the country, those are knock-on effects of the investment of the royalties or cash flow that came into government coffers as a result of a particular investment that one investor brought into the economy, and it makes it more attractive for other investors. Some investors may be coming here and they come in and say, "Oh, the roads aren't great, so I'm not gonna come." So if you're able to extract a little bit more to fix your roads, that investor will come because of great roads. Some investors may say, healthcare delivery is poor. I'm not setting foot in that country. Just by putting up the right level of healthcare infrastructure could attract that investor. So there are really cause and effect outcomes that we need to manage critically and carefully when looking at those variables. Thank you. Hello? Hello? Can I be heard?
Yes, you can. Thank you very much. I think we're speaking, but we can't hear.
Hello.
Yes, we can hear you now.
Yes, thank you, Mr. Kudia Sapon. Thank you for a wonderful presentation, taking time to answer our questions as well. This brings us to the end of the presentation and the questions as well. There's a link in the chat box for participants to send some feedback. We appreciate you taking time to fill out the survey. Well, I
Just
like
I have two last things to add. So for anyone who's interested in the presentation, the subject matter, and wants to do a little bit more reading, all I'd say is these are some additional resources that cover the subject of infrastructure finance and project finance. They are my favorite texts, and I think anyone who wants to read up on the subject should really zero in on these specific texts, and it should be very useful to all of you. My favorite one is the Lazard Annual Levelized Cost of Energy report. It gives you, from a global perspective, what for each energy or energy source, what the levelized annual or global cost looks like, and that should be able to allow you to build your financial models. Those of you in commerce or commercial space, or the engineers who are still doing a bit of financial modeling, it should be able to help you benchmark your project against the international projects more efficiently. So that is one resource that I think everybody should take a look at when they have the time.
Okay, thank you.
The second thing I wanted to talk about was, I saw one question here that it will pain me if I don't answer it. Although Ghanaian banks offer forward contracts and currency swaps up to 90 days for the USD, to ease ECG's FX risk exposure, is this tenor sufficient for ECG's long-term US denominated PPAs and fuel obligations? The answer I can tell you here is, well, it depends. They may have long-term obligations and long-term PPAs, but if ECG itself doesn't understand its risk properly, then of course it won't be able to mitigate them in an efficient manner. 90 days, some banks can do 1 year, some banks can do longer. It depends on who you are talking to in the market. But certainly, if you're in ECG and you have this question, this looks like somebody who's in ECG. So I'll be happy to answer that question offline. We can have a chat around what type of structures and solutions exist to solve ECG's FX problems. So you can, on the basis of that, give me a call, which I'll share this presentation with Yao and the team, so they can share it with your good selves to have a look at it. Anybody can reach out to me for further conversations. Thank you very much.
Thank you, Mr. Kodiasapon. Okay, so we move on to highlight a few upcoming events. But before we do that, we would like to spotlight Abena Owusu Yeboah. She's been the February spotlight for this month. Abena is a completion engineer with Slumber-J. She's a young energy professional with 5 years experience. She's an alumni of the Kwame Nkrumah University of Science and Technology, and she holds a BS in petrochem engineering. She's hardworking and determined and results driven. Abena, congratulations. There's also a call for participants for the upcoming YP intersectional debate. The deadline is 3rd March 2026. We're asking all who are seeking to participate to send in your interest. Upcoming events, as most of us may know, in May we have our BICE SP's major event. We also have the YP workshop, which will be just around the BICE. And then we'd like to now invite Isabella Donko to give us a vote of thanks.
Thank you, Carl. Could you confirm if I'm audible?
Yes, please, we can hear you.
All right. Thank you, and good evening to us all, and well done on staying to the end of this lecture. First of all, would like to thank the YP and then the Students Committee for putting such a great event together for us to have benefited. We would also want to give our most sincere gratitude to our speaker, Mr. Kojo Asapon, for being with us and giving us this financial education. And I personally believe that as engineers, it's also good that we get acquainted with these financial literacies so that we'll be able to be all rounded. Personally, one of my key takeouts is the fact that financial engineering is not just going to be enough. We also have to consider the economic factors, the risks that we have to allocate, and then also to look at the financing again, so that we'll get to align our frameworks around our infrastructural projects and to make our project bankable. This is very insightful. We are grateful to our speaker for educating us. I would also want to thank the section executives for joining us, our audible audience and our non-audible audience. We are grateful for all of you for joining. We are grateful to all of you for joining us tonight. And I believe that we've learned great things today and we'll be applying it in our various disciplines. Thank you so much and have a good evening.
Thank you very much, Isabella. We also like to recognize and acknowledge our session chair, Mr. Richard Amorin, who's made the time to join us today. We appreciate you, Chair. We appreciate you for joining us. And thank everybody for joining. Celestina as well, Session Director. We thank you for taking time to join us today. We appreciate you all and we look forward to having you all on the next session. Thank you.